Stellantis just detonated a pricing bomb that's shaking the entire U.S. auto market to its core. In an unprecedented move, the global auto giant, home to brands like Jeep, Ram, Dodge, Chrysler, and more, has unleashed jaw-dropping discounts across its lineup, sending shockwaves through dealerships, competitors, and Wall Street alike. We're not talking a few $100 off MSRP, no, these are multi-thousand-dollar slashes that are flipping the script on how cars are bought, sold, and valued in 2025. Industry insiders are calling it a bold power play to recapture market share and clear out ballooning inventories. Stellantis is reportedly offering up to $15,000 off on some models, including full-size Ram trucks and loaded Jeep Grand Cherokees. That's not just competitive, it's aggressive, and it's forcing Ford, GM, and even Tesla to re-evaluate their own pricing strategies in real time. Dealers are scrambling to update their pricing boards, and buyers? They're flooding lots and online showrooms, looking to cash in before these discounts vanish. This move isn't just about sales, it's about survival. With EV adoption still sluggish, interest rates sky-high, and consumer confidence wobbling, Stellantis is pushing hard to move metal now, not later. Analysts say the company is trying to reset the market and get ahead of what could be a brutal Q4 for auto sales. And guess what? It's working. Early reports show a surge in showroom traffic and a noticeable uptick in financing applications, even with those tough lending rates. But this aggressive pricing strategy could come at a cost. Margins are already thin, and offering massive rebates could hurt short-term profitability. Still, Stellantis seems willing to play the long game, betting that volume will win over margins. And there's another layer here, dealers themselves. While some are thrilled about the foot traffic, others are privately venting frustration, saying the sudden price drops are devaluing recent customer purchases and creating confusion on trade-ins. One dealer in Texas said, "It's chaos, in a good way. Phones are ringing off the hook, but customers who bought last week are asking for refunds." Now here's where things get even more intense. Industry watchdogs are questioning whether this pricing war could trigger a domino effect, leading to a full-scale price collapse across the industry. If Stellantis holds the line on these discounts and moves enough inventory, Ford and GM might have no choice but to follow suit. We're already seeing hints of this, early signs of discount creep on Ford F-150s, and whispers that Chevy dealers are preparing their own incentive blitz to avoid being left in the dust. The fear among automakers is real. Once the floodgates open, it's hard to close them without hurting brand value or residuals. Meanwhile, Wall Street is watching closely. Stellantis stock popped slightly after the news broke, but analysts are split. Some see it as a genius move to stimulate demand in a softening market, while others warn it could signal desperation, especially if these incentives become permanent fixtures. The automotive sector has always walked a tightrope between volume and value, and Stellantis just threw a 500-pound weight onto one side of the scale. Let's talk models, because this isn't just happening on slow-selling trims. The discounts are hitting across the board: Ram 1500s, Dodge Chargers, Chrysler Pacificas, even some electrified Jeeps are getting price cuts. We're talking lease deals as low as $299 per month with zero down. That's unheard of in the current interest rate environment. And customers are responding fast. Dealership websites are seeing traffic spikes of up to 300% in some regions, with some even reporting sold-out inventory on specific trims just 48 hours after discounts were announced. It's not just about the sticker price either. Stellantis is stacking incentives, cash back, loyalty bonuses, dealer rebates, and special financing offers all at once. It's an all-out blitz to pull buyers off the sidelines. And here's the kicker: insiders are saying this might only be the beginning. One unnamed source close to Stellantis leadership hinted that Phase 2 of this campaign could roll out in September with even deeper cuts and nationwide ad buys to blanket the airwaves and social media. That's a signal, they're going for broke. This has left every other automaker scrambling. Tesla, already known for its flexible pricing, now finds itself at risk of losing budget-conscious buyers to heavily discounted Stellantis EVs. GM is reportedly in emergency meetings with its dealer network, and Ford is reviewing its fall pricing roadmap as we speak. Meanwhile, Toyota and Honda, who traditionally avoid deep discounting, might be forced to reconsider their stance if market share starts shifting dramatically in Q4. And let's not ignore the used car market. Dealers are already warning that these price cuts are hammering trade-in values. Someone who bought a new Jeep Grand Cherokee 6 months ago might find their car now worth thousands less overnight. That's fueling a surge in complaints and could trigger a new wave of negative equity situations, something the industry has been trying to avoid since the chip shortage era artificially inflated car values. If the gap between new and used prices keeps narrowing, used car dealers could be looking at serious inventory write-downs in the weeks ahead. And in the middle of all this chaos, buyers are asking one key question: is now the time to buy, or is there an even bigger drop coming? That question is creating a frenzy of analysis across car forums, Reddit threads, and TikTok finance influencers. Some argue this is the sweet spot: massive incentives, high inventory, and dealers hungry to close deals before the end of Q3. Others are urging caution, suggesting that if Stellantis goes even further next month, prices could dip again, and early buyers might miss out on even deeper discounts or updated financing offers. But here's the truth: timing the car market is becoming as unpredictable as the stock market. There are so many variables: manufacturer strategies, interest rates, dealer inventory levels, and even global supply chain hiccups, that predicting a perfect moment is nearly impossible. What's clear, though, is that Stellantis has shifted the entire landscape, and now every player has to react. Whether that means price cuts, added features, or aggressive lease packages, buyers are back in the driver's seat, and automakers are suddenly playing catch-up. Let's zoom out for a second, because this move by Stellantis isn't happening in a vacuum. It's part of a broader shift in the automotive industry, where traditional pricing models are being rewritten in real time. For years, automakers leaned into limited supply and high margins, but the post-pandemic economy isn't playing along. Consumers are maxed out, inflation has eaten into discretionary spending, and even with cooling interest rates, financing a $60,000 truck isn't an easy sell. Stellantis is acknowledging that reality and forcing the rest of the industry to confront it, too. Behind the scenes, there's tension. Auto unions are watching closely, wondering what deep discounts now might mean for production levels later. Suppliers are questioning future orders. And even rental car companies, who buy vehicles in bulk, are reportedly renegotiating fleet deals to reflect the new pricing environment. The ripple effects of these discounts are massive. They don't just affect consumers, they impact nearly every part of the automotive supply chain. One major wildcard in all of this is the EV transition. Stellantis, like its competitors, has heavily invested in electrification, but EV demand in the US is plateauing. Price remains a major barrier, and that's why we're now seeing incentives hitting plug-in hybrids and even some BEVs under the Stellantis umbrella. The move is clear: if they can't win on tech alone, they'll win on price. And with the upcoming release of several electric models, including lower-cost variants of the Dodge Charger Daytona and Ram REV, these discounts might be just the beginning of a much larger price reset across the EV segment. And now all eyes are on the next few weeks, because what happens between now and the end of September could determine the direction of the entire auto industry heading into 2026. If Stellantis manages to significantly boost sales volume with these discounts, expect a chain reaction. Ford, GM, Hyundai, even the import heavyweights like Toyota and Nissan, none of them can afford to sit idle. We could be on the verge of a full-blown price war, something the industry hasn't seen at this scale since the aftermath of the 2008 financial crisis. And the stakes? They're higher than ever. We're talking about razor-thin margins, massive R&D costs tied to electrification, and global supply chains still not fully recovered. Automakers don't have the same cushion they once did. A few months of heavy discounting could mean layoffs, plant shutdowns, and delayed product launches. On the flip side, if Stellantis fails to convert these deals into sustainable demand, it could spark a crisis of confidence across the board, one that might send dealership floor plans and automaker stock prices into freefall. And don't forget the impact on leasing. For years, leasing offered a way for consumers to drive new vehicles at lower monthly costs. But recently, lease prices have surged due to high residual values and limited supply. Now, with Stellantis slashing lease rates across multiple models, it's breathing new life into that market. Families who thought leasing was off the table are now reconsidering. In fact, insiders suggest leasing might become the centerpiece of Stellantis' next phase of this campaign, making it easier for cost-conscious drivers to jump into new cars with shorter-term commitments. But here's what's really interesting: Stellantis isn't just chasing short-term wins. Some analysts believe this move is part of a long-game strategy to rebrand its US presence. With new models in the pipeline, including modernized versions of the Dodge Charger, refreshed Jeep SUVs, and the much-anticipated return of certain legacy nameplates, Stellantis may be laying the groundwork for a full-scale brand reinvention. By drawing in customers now, through price, they can build loyalty ahead of their 2026 to 2027 product wave. Still, the road ahead is anything but smooth. Questions are mounting around dealer relationships. Some franchise owners are grumbling behind closed doors, frustrated that they're being forced to move cars at a loss just to meet volume targets. There's growing tension between corporate and the showroom floor. If dealers start pushing back publicly or refuse to accept new inventory under these pricing terms, Stellantis could face internal resistance at the worst possible time. And then there's the government lens. Consumer advocacy groups are starting to question whether these pricing swings could hurt long-term market stability. There's talk, quiet for now, but growing, that regulators might step in to review dealership transparency or investigate how sudden discounts affect loan terms, especially in lower-income communities. The concern? That these deals might be masking inflated interest rates or aggressive upselling practices that cancel out the consumer savings on paper. And while all of this unfolds, consumers are still trying to navigate the maze of what feels like a once-in-a-decade buying opportunity without getting burned. The average car shopper right now is juggling a dozen variables: price drops, fluctuating APRs, trade-in values crashing overnight, confusing rebates that vary by zip code, and limited-time offers that expire before the weekend. It's a whirlwind, and Stellantis knows it. That's why their marketing is laser-focused on urgency: act now. Save big. Inventory won't last. But the truth is, this isn't just a fire sale, it's a turning point. Stellantis has lit the fuse, and the rest of the auto industry is now racing to keep up or risk being left behind. The old rules of car buying, waiting for year-end clearances, negotiating from MSRP, assuming prices will only go up, are being rewritten in real time. What we're witnessing is the start of a major reset, not just in pricing, but in how automakers relate to customers, manage dealerships, and position their brands in a volatile market. So, where does this leave you? If you're in the market, do your homework now. Know your local incentives. Get pre-approved. Don't assume that today's price will be there tomorrow, and definitely don't assume the dealer knows more than you do. The power dynamic has shifted, and informed buyers are walking away with unprecedented deals, especially on Stellantis brands. If you've already bought a vehicle recently, don't panic, but do pay attention. If trade-in values keep dropping or new incentives affect your equity position, it might be worth talking to your dealer about options. Some are offering price protection for recent buyers, while others may help restructure deals to avoid negative equity. It's all case by case, and the only constant right now is change. And if you're just watching from the sidelines? Keep watching. Because this Stellantis bombshell isn't a one-day headline, it's the opening move in what's shaping up to be a full-on battle for control of the American car buyer's wallet. Q4 is around the corner, and if Stellantis holds this course, or doubles down, it won't just reshape their year-end numbers. It could redefine pricing strategy for the entire US auto market. So buckle up, because the next chapter is coming fast.